Welcome to part two of this 8-part lecture series titled The Coming 2026 Financial and Economic Crisis. How to tame economic cycles is an issue conventional economics has studied and debated for the last 140 years. The record suggests to many that we have learned how to use legislation, regulation, as well as fiscal and monetary tools to prevent long-term systemic contractions that inevitably plague our mixed economic system. Or more accurately, that once the contraction occurs, government takes whatever level of corrective action is deemed necessary to lessen the depth and duration of even a depression-like contraction. However, confidence in existing tools and policies is under challenge by a broad spectrum of critics. The criticisms have a long history. Some critics continue to yearn for a return to the time when government simply waited for the economy to self-correct. Others continue to argue that government still lacks the tools to effectively manage the economy as needed. The stresses that brought on depressions in the past have not disappeared, despite the fact that beginning with the presidency of Harry Truman, economists have had a seat at the table. One of the many outspoken critics within the economics discipline is Professor Richard Wolff, now on the faculty of the New School in New York after a long teaching career at the University of Massachusetts. As a serious student of Karl Marx's writings and a strong proponent of democratic socialism, Professor Wolff argues that the system we call capitalism must be replaced, not simply reformed. His reason is simple. Wherever capitalism has settled in the world, it has a crash on average every 4 to 7 years. Some are short and shallow, others are long and deep. What systemic changes would Professor Wolff like to see come into widespread adoption? He is not an advocate of central planning or state socialism. Rather, he sees cooperative enterprise as offering the right balance between property rights and human rights. Right now, there are some 30,000 cooperatives in the United States with an estimated revenue of $154 billion and employing over 2.1 million people. This is, to this point, still a very small part of the U.S. or global economic picture. Professor Wolff suggests that we look to Spain and the Mondragon Cooperative Corporation for instruction of what is possible. He tells us, Mondragon started in 1956. A Roman Catholic priest named Father Arizmendi gave this sermon about not waiting for someone to come in and give everyone in Mondragon a job. It started with 6 people, and today there are more than 10,000 workers and dozens of co-ops within the corporation. They do everything: manufacturing, services. They maintain, by the way, their own university. They have their own bank. They also produce food on farms. You will not see giving huge salary packages to a half a dozen executives at the top, while the average worker in the establishment cannot pay for their kid to go to college without taking crippling loans. Plenty of people have taken notice of cooperatives long before Professor Wolff has emerged as a vocal champion. What is important about Professor Wolff is that he has the academic credentials with which to gain a seat at the table in order to challenge long-standing economic theories and teachings. He is not easily dismissed. He has a large and growing following. What economics professors now face more and more frequently are students who question the legitimacy of what is being taught in the classroom. Rethinking Economics USA Network is an international network of students, academics, and professionals calling for fundamental changes in what is taught. They state, economics in universities is narrow, uncritical, and detached from the real world. It is taught from one perspective as if it is the only legitimate way to study the economy. There is no room for the critical discussion and debate that is essential for any student to engage with real-world economic problems. The most used definition of economics as a discipline is that it is the study of the allocation of scarce resources. Importantly, one must ask whether economic instability occurs because the input from economists is in important respects ignored for reasons of political necessity or ideological bias, or is some or much of the input from economists simply wrong. The evidence suggests that both problems work against solving what is sometimes referred to as the economic problem of limited resources and unlimited wants. We need to acknowledge the fact that the enormous concentration of wealth and income at the top in nearly every society means that the systems of law, of taxation, and of public policy generally reflect a parallel inequity of influence and control over the political processes. The World Economic Forum has undertaken what is referred to as an agenda in focus, fixing inequality. Just how serious is this initiative we will eventually learn. How much these people really understand and how far they are willing to go for systemic reform is another concern. The state of our reality is described as follows. The global economy is not working well enough for enough people. Right now, just 1% of the world's population holds over 35% of all private wealth, more than the bottom 95% combined. According to Oxfam, the 8 wealthiest individuals in the world, all men, have the same wealth as 3.6 billion of the world's poorest. The world could see its first trillionaire in the next 25 years. Yet 1 in 9 people go to bed hungry every night, and 1 in 10 of us still earns less than $2 a day. These are the facts, or at least some of the facts. If by some chance I was invited to speak to those assembled at the World Economic Forum on the cause of wealth inequality, I would start with some basic insights from analysts that describe the world in which we actually live. Here is one small lesson I would present to them and try to explain its importance. In a world where we humans have unlimited wants but have access to limited resources, our mixed economy sets up a structure where the so-called price mechanism ostensibly operates to clear markets, that is, to come to an equilibrium price where those who supply goods or services and those seeking to purchase them are satisfied with the price paid and received. A very real problem exists with how modern textbooks explain these interactions. The problem is that the price mechanism does not fulfill its function where nature is concerned. Nature has a fixed or inelastic supply. We can use our labor and capital tools and technologies to change what nature provides to us free of charge. We can achieve a remarkable increase in output per unit of input. But we cannot increase the natural resources out of which everything comes. Thus, the supply curve for our inelastic nature is appropriately graphed as a vertical line on the chart. What this simple graph does not show, however, is that in the real world, under existing tax regimes, as demand for nature, that is, the economic factor long referred to as land, increases, and the price people are willing to pay for control of land increases, the supply curve will become leftward leaning. The reason is simple. Those who control nature, that is, land and land-like assets, will often hold land off the market in anticipation of further gains in offered prices. Prices are pulled upward and upward by artificial scarcity. As shown here, the supply curve for nature is actually leftward leaning because rising prices trigger hoarding and speculation in anticipation of ever higher prices. Sooner or later, those who need land for productive use are unable to pay the asking price and earn an acceptable net return on their investment. An economic contraction results. Production slows, workers are released, factories are closed, and the inevitable cyclical crash occurs. There is a simple remedy available. Think for a few seconds what will happen to the asking price of building lots in a city, for example, if lots held vacant for years or even decades are added to the supply of lots offered for sale for development. As holders of these vacant or underutilized lots compete with one another for purchasers, land prices will fall to levels that allow for profitable development. The policy issue then is how to encourage owners to develop the land they hold to its highest, best use or sell to someone who will. Heavy speculation in land, as broadly defined to include all natural assets with an inelastic supply, is a primary cause of market collapse, of recession, or worse. Here is just a partial list of some of the most important natural assets that have a vigorous market and attract intense speculation. Locations in towns and cities, tracts with forests or subsurface minerals, agricultural land, commercial fish stocks in the oceans, lakes, streams, and rivers, frequencies on the broadcast spectrum, routes around the Earth for satellites, and takeoff and landing slots at airports. Political economists, economic historians, economists, and many non-specialists have been analyzing the causes of financial and economic crises that have occurred from the very beginning of the shift from feudal craft guilds to market-driven production and commerce undertaken by sole proprietorships, partnerships, corporations, and even cooperative enterprises. Their findings are worth studying today. The writings of mercantilists, of the French school known as physiocrats, of the English classical school, and subsequent generations of analysts each offered insights into the causes of systemic instability and offered what they thought were practical solutions. This image indicates the modern understanding of each phase of the business or economic cycle. As long ago as the 17th century, the cycles were both observable and measurable. The statistics we capture today ought to provide a robust ability to determine where we are in the cycle and forecast what is coming over the horizon. For many reasons, this has proven to be elusive. These lectures will attempt to provide insight into how to solve the problem. Remember that one of the primary measurements relied upon for how well our economy is doing is the calculation of gross domestic product. Note here that nominal GDP in red is moving up slowly each year until the mid-1970s. The prices of goods and services then begin to climb, so that nominal GDP would increase even if the aggregate depreciated value of capital goods was increasing far more slowly or not at all. Until the late 1970s, mainstream economists accepted the analysis of A.W. Phillips that inflation and unemployment have a stable and inverse relationship. The global economy was then shaken severely by dramatically increasing oil prices. Stagflation, increasing inflation accompanied by increasing unemployment, was the result. To deal with stagflation, the Federal Reserve under Paul Volcker decided that curbing inflation required a dramatic contraction in the availability of credit. The federal funds rate was increased from 11.2% in 1979 to 20% in June of 1981, resulting in the prime rate of interest increasing to 21.5%. A recessionary downturn resulted, and the official rate of unemployment rose to over 10%. The election of Ronald Reagan to the U.S. presidency added a new dynamic to the economic cycle, policies of new federalism designed to return responsibility and authority to the states, the beginning of a long period of deregulation of the nation's financial sector, and a significant lowering of the marginal rate of taxation on individual incomes and on businesses. Unfortunately, the supply-side effects of Reaganomics failed to generate an increase in federal revenue forecasted by its chief proponent, Arthur Laffer. Federal spending under Reagan continued to increase, in particular on the military. Deficit spending became the norm during every administration that came after Reagan. The demands on the federal government to pump new money into the economy in response to the financial crisis and the COVID-19 pandemic have resulted in a level of public debt that might be impossible to retire by means of revenue raised by taxation. The mix of how revenue is raised constantly challenges the ability of government and the central bank to use their powers to achieve a sustainable, non-inflationary economic climate. Advice and criticism streams in from all parts of our society. An intensifying debate has arisen over whether a country such as the United States, which is a sovereign currency issuer, needs to be at all concerned about the level of bonds held by individuals, private entities, the central banks, or other nations or other governments. This debate centers around what is referred to as modern monetary theory, or MMT. Stony Brook University economics professor Stephanie Kelton is one of a growing number of analysts who argue against conventional economic wisdom where government budgets and spending are concerned. In her book, The Deficit Myth, published in 2020, she lists the 6 myths her book exposes. First, the myth that the federal government should budget like a household. She challenges the notion that revenue should be raised prior to any expenditure, or that the federal government borrow only as absolutely necessary in response to short-term and unanticipated revenue needs. Second is the myth that deficits are evidence of overspending. She argues that most of the time deficits are too small, not too big. Only when inflation occurs is this evidence of overspending. She is confident that monetary expansion can be so managed that inflation will be modest. Third is the myth that deficits will burden the next generation or generations. She presents data indicating that deficit spending has consistently led to a higher standard of living without necessitating higher taxes. Fourth is that government borrowing crowds out private investment and therefore short-circuits long-term economic growth. Instead, she argues that government deficits act to increase private income generated by savings, and this increased income is then available for private investment. Fifth is the myth that deficits make the United States dependent on foreigners, who then gain leverage over us. She urges us to look at what actually occurs. Foreigners accept U.S. dollars as payment for goods and services. They can either hold the cash in reserve, invest in U.S. government securities, or use the dollars to make purchases of U.S.-produced goods or services, purchases of shares in U.S. corporations, or purchases of natural assets. Sixth is the myth that entitlements are propelling us toward a long-term fiscal crisis. Instead, she says the U.S. government will always be able to meet future obligations because it can never run out of money. Our money is a fiat currency, not backed by gold, silver, or any specific tangible good. While it is certainly the case that the U.S. government can never run out of money, this does not reduce what should be of the highest concern, which is to finally create a system of public revenue that charges individuals and private entities based on the value of benefits received. By this criteria, rents of land, of all natural assets and all competition limiting licenses rightfully belong to the community and are by definition non-tax revenue. This argument is unfortunately neither widely accepted nor widely discussed. Our ability to tame economic cycles depends on a broad public understanding of the consequences of maintaining the status quo. Failure to fully collect the rents generated by control of these natural assets or government-created assets is first a fundamental injustice that threatens our democracy by the transfer of wealth and income from producers to the beneficiaries of rentier privilege, who offer nothing in exchange for the wealth they extract from others. And second is a fundamental cause of the instability at the root of economic cycles.